Placing a stock trade is about a lot more than just tapping a button. When you start a position, you're putting your own money on the line. It's important to be prepared. So let's take a look at a few things you may want to consider before placing your first trade. First, make sure you have a well-formed opinion about why you're opening the position. Second, know when you plan to exit. And third, check to see how the trade might affect your overall portfolio. Let's walk through these considerations one by one. One powerful thing you can bring to trading is a well-formed opinion about the stock you're watching, as well as about the broader markets. To formulate your opinion, there are a number of strategies available to you. For instance, a good rule of thumb is to follow the money. Here's how. Markets are made up of buyers and sellers. One thing you can do is chart price trends to determine which side is currently in control. If buyers are, you might want to be a buyer. But if sellers are, you might not. Or you might want to sell a long position you already hold. Next, when to exit. That is, when to get out if the trade isn't working. And equally important, when to take your profit if it is. Let's consider managing downside risk first. This is one of the most important and overlooked aspects of trading. Determining when to cut your losses is just as essential as determining when to lock in your gains. Consider creating a simple risk management plan before you place your trade and using a stop order to enforce it. The stop will get triggered automatically if the stock moves against you and hits your risk-loss target. If you wait until you already hold the stock before considering a risk management plan, your emotions could get in the way and cause you to take an even bigger loss. On the other hand, if your opinion was correct and the stock rises, how might you determine when to take a profit? It's generally a good idea to reassess your position as conditions change. While it's impossible to predict the future, you can use charts, technical indicators, fundamental analysis, and other tools to help evaluate the trade. As with downside risk, discipline is key. Setting a trailing stop order can help you keep unrealistic expectations in check, while still allowing room to run if the stock continues to rise. Finally, before placing the trade, you may want to check that your portfolio is well balanced. If it's heavily concentrated in a particular sector or industry, increasing your exposure could set you up for big losses if market sentiment turns against you. But finding a stock that's differentiated shouldn't be too difficult. There are literally thousands of stocks to choose from across a wide variety of sectors and industries, and the market has new trading opportunities every day. As you can see, trading starts long before you get into a position. It's helpful to know ahead of time what and why you're trading, when you plan to get out, and how your trade fits into your overall portfolio. Spending a little time to answer these questions can go a long way toward increasing your likelihood of success. Want to learn more about trading? Visit etrade.com/education for ongoing education and training, including webinars, online tutorials, and more.